John Knorring was a managing director at Goldman Sachs during the golden age of Wall Street.
When I first started trading, there was an actual physical pit we used to call down, and we had a guy, his job was to stand on the edge of the ring all day, listening to the phone, listening for orders to come in, and reporting what was going on in the market. You had to know what your position was at all times, and if you didn't, you got fired. It was a very different experience from what today, because there were so many more people involved and personalities. When the electronic trading came out, that really changed everything. Today, because so much stuff is just basically done electronically, you don't know who's on the other side of it. You don't know what they're feeling. And there's nobody to go out to dinner with to talk about the market.
After 12 years at Goldman, he went on to trade commodities at DRW.
Do you think that discretionary trading can be fully automated?
Think about the gold market. If you had this strategy running in 2015 or something like that, there would not be a possibility of the gold market trading 4,000. What you've seen in the last 8 weeks or so with just the prices going vertical, that is not found in the history of the gold market anywhere. I think humans matter.
Now he's the founder and CEO of Green Tiger Markets, building liquidity and price transparency in emerging energy markets like the Philippines.
Nobody in the world knows what the price of Philippines electricity is because it's not publicly traded until 2 years ago. But what I can tell you is we think that the Philippines market is going to be really big and really interesting.
John, thanks so much for doing this.
Ethan, thanks so much for having me.
You led natural gas trading for Goldman Sachs. What was that like?
It was exciting. It was stressful. It was a lot of fun. It was terrifying, and a really fantastic experience. And the whole experience that I had at Goldman, which was actually, I was an intern there in between junior and senior of school, and ended up joining full time. So I started there. I cut my teeth, so to say. And yeah, it was a great experience. And actually, the time that I was there, so I joined in 2003 full time, and we had like a really exciting kind of series of events. So we had, kind of right out of the gates, we had Hurricane Yvonne, which was a huge storm, huge hurricane, which at the time, natural gas was really impacted by Gulf hurricanes. Let's see. So that was kind of like 2003, 2004, right around there. We had Hurricane Rita and Katrina in the same year, which was devastating to definitely the city of New Orleans, and the offshore production of oil and gas. We saw the market rip higher when that was going on. Then we had Amaranth in the market. So prior to, I know you're a student of financial markets. But prior to the financial crisis, the largest financial loss of any firm was Amaranth, where they blew up in over the course of about 2 or 3 days. But it was really challenging to make money when, at least in the in the kind of months leading up to their demise, as the prices were doing kind of strange things. When Lehman Brothers went bankrupt, Goldman purchased the natural gas option book from them. And that was, when I said terrifying, that's the moment I was thinking about, when we took on this massive piece of risk, and the markets were very dislocated, and we had a huge position on, and we, did our best to manage risk.
No, sounds like a period where you were there. Sounds super eventful. I mean, you said you started in 2003?
Yeah, I was an intern in 2002 and then started full time.
One of the things I'd like to hear more about is the technical infrastructure. How did it look like back then? How trades were actually placed versus today? Because, I feel like today everything is done. I mean, trading is mostly algorithmic. I mean, for the most part, and that's sort of how we do things now. But back then, tell me, what was it like, and how did that technical transition look like, especially?
Yeah, so it's part of the reason why I don't trade anymore. So when I first started trading, There was an actual physical pit, which if you've seen like Trading Places, it was just like that. And so we used to call down, and we had a guy that his job was to stand on the edge of the ring all day, listening to the phone, listening for orders to come in, and reporting what was going on in the market. Um, it was interesting, but it also gave you a lot of context because you could hear the emotion in people's voices. You could hear the background would get louder, and now that caused an emotional response, but it also kind of gave you a signal that something was going on. We used to write down. We had order tickets that we would write down what we bought and sold. And actually, for quite some time, there was a guy that traded GSCI, and he just had a pencil and paper and wrote down all of his trades during the day and handed that off to get input into the system. But the trading systems we had actually at the time were really good. They're still very, very powerful. At least when I still talk to people over at Goldman, they're still using a similar risk system. From a UX perspective, it's not elegant, but it's really powerful in terms of being able to see your risk. And at Goldman, you had to know what your position was at all times, and if you didn't, you got fired. And they were really adamant about understanding what risk you have on, how it's acting in the market. And the systems we had, though, were really good, such that we could keep up with that. And so when an event like the Lehman Brothers collapse comes up, we could absorb, we could, come up with a price. We came up with a price in about 30 minutes for their entire book, which was about 500,000 options and about 17 million Vega. And so we were able to absorb or ingest all of those positions, figure out what the risks look like, and then come up with a price on the book buy very, very quickly. So, but to your question about how trades were placed back in the day versus kind of when I left, it was very much over the phone to start. ICE, Intercontinental Exchange, was just becoming a thing. Electronic trading was just becoming a thing. There were actually a few guys that were trying to arb the electronic market versus that it. I think they did pretty well for a while, but eventually it just basically all the volume moved over to the electronic side of the market, which mind you it was more fair. Like the pit, there's a lot of humans involved, and there's opportunities for inefficiencies, let's just say. So, but yeah, when the electronic trading came out, that really changed everything. At the time, I didn't really have any gray hairs, and the gray-haired guys would complain about all the algos coming in and destroying the market. I kind of felt the opposite. I was like, the bid offers used to be a penny wide, now they're a tick wide. Yeah, it's only for 5 or 10 contracts, but that's kind of what it was before. And maybe you would get, if you got more, you did not want them. So, so the liquidity in terms of the width of the bid offer really compressed a lot. And actually, in my time making prices for clients, we saw the bid offer go from several pennies down to a tick or two in terms of the bid offer that we could show to clients, such that they would trade. And, the interesting thing is, and I see this a lot with what I'm doing today, is as that bid offer collapsed, we actually ended up making more money. And that's because we could have bigger positions. We would be more comfortable having risk on the market because we knew that we could get out of things. And when we wanted to get something on, we could get a lot on when there was more liquidity. So even though the margins really compressed, and nobody likes it, when your margins get compressed, but if you're able to do a lot more business and open up new lines of business because there's this added liquidity, it really makes a difference. But yeah, as far as automated price making, when I left Goldman, we were working on a project to basically start automating some of the smaller prices. So if a client called and said, "Hey, I want 5 contracts," it would drive me nuts because I said, I've got 5,000 contracts on. Like, I can't lose focus for the 10 seconds that it takes to make that price. Let's have the machine do it. And frankly, I didn't care what price the machine, as long as it was sort of close to the market. I was like, all right, hey, that's good enough. I ended up leaving before we implemented that project, but it was definitely a lot of fun working on it. But today, yeah, a lot of trading is done algorithmically. I mean, you can see it in like the Citadel volumes. They're, huge liquidity providers across a wide variety. Well, it's not only Citadel though. There's, several huge liquidity providers that are out there that really are basically trading algorithmically. And it's not, a bunch of old guys with gray hairs that are just saying, I think it's going up. So yeah, the machines are doing their thing, and they're pulling in data. There's way more data today than there used to be, and that's actually kind of what pushed me out of the market. Was I don't code. I'm not a coder. I'm a trader, and because I didn't code, I basically couldn't keep up with the market, and so yeah.
The pits and the loud environment, having that guy on the phone, it seems like a different world. It seems super fun. That's what I will say. Like when I watched what was that like? I imagine the energy of the environment just it was exhilarating. But I'd love to hear it from you.
Yeah, it was a very different experience from what you see today, because there were so many more people involved, and personalities, and so many other people that were kind of going through the same life experience. Whereas like today, because so much stuff is just basically done electronically, you don't know who's on the other side of it. You don't know what they're feeling like. You can't tell if they're stressed. And there's nobody to go out to dinner with to talk about the market. There's some people still, definitely, but it was like there were hundreds and now there's a dozen. So it was a lot of fun. The social aspects of it were great. I got to experience a lot of different really kind of fun things in New York City and actually around the world, being a commodities trader. So yeah, I thought it was great.
And while you were at Goldman, so you were there from full time from 03 to 2013, correct me if I'm wrong? 15. Okay. And Dodd-Frank was 2010?
I think it passed in 2010, but it was kind of being implemented. It took kind of a few years before things like the rules got finalized and written. And I got to tell you that like the financial crisis changed things. And when Goldman converted to a bank holding company from an investment bank, it really changed the way things worked inside the firm. But Dodd-Frank had the effect of really kind of throwing a wet towel on the commodities business and actually kind of a lot of the trading businesses, because we basically just weren't allowed to take the same kind of risks that, as an investment bank, we can kind of do whatever. And before Goldman was public, it was all partner capital. So, there were people that were breathing down your neck that were a lot more serious than a regulator. So, the Dodd-Frank really changed things a lot. It meant that we couldn't do the same kind of trades. We couldn't hold positions like we wanted. Around that same time, the compensation structure really changed. And yeah, it just it was not good. I mean, it's part of the reason why we saw a massive exodus of traders from kind of 2010 through 16, from not just commodities, but all over Goldman and the big banks.
Yeah, and I mean, 2015, you left Goldman and jumped to DRW. What was that shift like?
Yeah, it was. When I was at Goldman, I worked on a floor with about 900 people, and at DRW there were maybe 30. And, I knew people in interest rates. I knew people in FX, emerging markets. Oh, go talk to the emerging markets bond guys, to figure out what's going on in, XYZ country. And it was great. And the environment if you wanted to learn anything, you could, walk over to whoever was in charge of trading that market. Oh, hey, tell me what's going on in 10 years. Seems like they've really been rallying like crazy. Like, what's going on? Or, we had a fantastic gold trader. All right, hey, tell me what's going on in the gold market. Like this, the chart looks good, but like, what's the story behind it? Um, the When I went to DRW, it's much more siloed. And so I was on a team of 4 or 5 guys, and we basically kind of talked amongst ourselves, and we talked a little bit with other people on the floor, but really they kind of kept to themselves. And kind of across the firm, there wasn't, I mean, you were encouraged to talk to different parts of the firm, but I sort of found that it wasn't, people were sort of like, hey, I'm busy trying to make money. I don't have time to explain to you like the basics of my market. And so, but hey, that was fine. It was much quieter. And actually that was a huge adjustment, was going from, like I said, a trading floor with 900 people, to one that, had, roughly 30. And it was pretty quiet there, during the day. So, yeah.
And what were the actual differences in the types of trades that you were putting on? And I guess more generally, because people at DRW can do, I mean, there's a million different things you can do within that firm, right? There's, correct me if I'm wrong, I think I'm sure they run some discretionary stuff, but they also do more market making stuff. And so what were you doing there, I guess?
Yeah, so DRW basically was founded by Don Wilson. He was a Eurodollar trader and Eurodollar option trader. And he was one of the first guys to use computer-driven strategies, which basically was, hey, I'm going to use a computer to calculate what the option prices are. And he was one of the first guys to do that. And the firm, though, had like a, latency sensitive trading program where they were trying, hey, a piece of economic data would come out and they would, trade on it, and they were very fast. And I go, like, the fastest gun wins 95% of the pot. And so that was kind of the core of their business, was providing liquidity to markets. And then when things kind of went haywire, it was usually basically one of their market makers was blowing up, that Don would notice and say, wow, this guy's losing a lot of money. Let's look at what's going on here and figure out, hey, like, has this market gone too far? Or, hey, is this a beginning of something big? And Don, he was not afraid to put positions on. He's a great guy to work for. And I was a little envious. He had, call it 60 or 70 pods that were in their markets, and they were, heads down, focused on trading. And when things started to go wrong, he could kind of watch from above. And but in terms of what I was doing there, when I joined, basically the pitch was, hey, I can take discretionary risk in commodities generally, but with a focus on energy. And that's basically trying to, buy things that go up and sell things that go down. And so, we started doing that, but it was a very different P&L path than market making. So market making was, hey, you either scratch or you pick a number, 50 grand a day. And in risk taking, it was sort of, okay, hey, we made $2 million one day, lost $1 million the next day, made 800 grand, lost 2 million. And it's one of these going, hopefully from lower left to upper right. But it's not a straight line path. And, there were some cultural conflicts that sort of brought to the surface. But in all, I really enjoyed my experience at DRW.
What was there any difference in the information that you would have access to trade on at Goldman versus DRW?
Yeah, quite a lot, actually. So when I was at Goldman, we quoted several of the largest commercial participants and hedge funds in the market. And so, if Chesapeake Energy called up and asked for a price, like they were either going to sell to you or to somebody else. So you kind of knew a piece of information that when I was sitting at DRW, I no longer knew that. And I just had to infer from the price action that some producer is out there selling into the market, not who it is, because it mattered whether it was a small guy, a medium guy, a big guy. And hey, if it was a big guy that historically would just sell as much as they could over like a 3-day period, that would massively impact prices. And so, when I was at Goldman, you kind of knew, all right, hey, so it was day one of the 3-day execution. There's more coming tomorrow and the next day, so kind of get out of the way. And at DRW, we didn't have all of that information. So that was different. And, at DRW, we didn't quote any clients, and we didn't do any liquidity provision. We were pure price takers. So, it was definitely, like when you can only be a price taker, it has its drawbacks.
And within DRW, what sort of other data did you have access to that led to hedge in a discretionary way?
Yeah. So, we subscribed to a bunch of the pipe data. And when I said, hey, there's way more data today, like when I first started trading, there were, call it over the course of the week, maybe 10 pieces of data. And one of them kind of was 80% of like if each piece of data had a value, 80% of it was in this one piece of data, which was Thursday morning, 10:30, when the EIA natural gas report came out, which told you how much was in storage. And so, with those numbers, you've got a pretty good idea, and energy commodities in general, like this stuff comes out of the ground at a fairly consistent rate, and you can either burn it or store it. And so that storage number, if it was bigger, like if it was during the injection season and it was bigger, that means we were burning less gas, and that, hey, maybe the price should go down quite substantially. Alternatively, if we were expecting a large injection and it came out pretty small, it's like, oh, wow, we're burning a lot more gas than we thought we were. If this continues for the next 3 months, we're not going to fill inventories by the end of the injection season, and things could get really spicy if it gets cold in the winter. So a lot of ifs in that, but that's the way the market priced things. So, but over time, and kind of the other data points were some of the weather runs, but over time, we started to get more and more data that came out on a more granular basis. And the effect of that was the Thursday number was a lot less impactful, because you kind of like your guess is, hey, if you were plus or minus 10 BCF in 2005, you were like plus or minus 2 BCF in 2020. So the kind of the information content to each piece of data was lower, but that meant you had to absorb all of it, quickly process it, and then act on it. And so that's why you saw a lot of the algorithmic trading strategies that were ingesting a lot of this data. And so we started ingesting that data. Like I said, I wasn't a coder, so we had some guys that were really good with Python, pulling stuff together, and it not so much generating a trading signal, but just giving us a better idea of what was going on and being able to visualize the flows in the market, as far as the gas flows in the market.
It's actually tomorrow morning. I'm having Bill Gebhardt on my podcast, and he, I think he used to trade at Deutsche, and he was a discretionary trader there, and now he runs a commodities trading hedge fund based out of London. And I think I was listening to him on Flirting with Models, and Corey Hofstein asked him a question about replicating discretionary in his discretionary investing process in a systematic way. And I guess I'd like to ask you a similar question. Do you think that discretionary trading can be fully automated? Do you think that that's doable, or do you think there's some non-linearity, so to speak, with the human mind and thought processes?
Wow. Great question. One of the aspects of a lot of these either AI or algorithmic trading models is they just look at the history of, well, they pull in a lot of data, but for example, think about the gold market. Like if you had this strategy running in 2015 or something like that, there would not be a possibility of the gold market trading 4,000. But from a discretionary perspective, for kind of the real long buy and hold type people, to have that view that, hey, this is a commodity that's going to go to an entirely different pricing regime. And actually, what you've seen in kind of the last 8 weeks or so with just, prices going vertical, that is not found in the history of the gold market anywhere. And you would probably have been fading the market in week 2 or week 3 saying, wow, this thing is extremely overbought. It can't go up like this. It doesn't go up like this. But not only did it, it carried on for another, 5 weeks, and, we'll see what happens this week, but I think it's going green again. So, yeah, I think humans matter. I've had a decent sized silver position on, actually, which is, kind of like gold on steroids. And, silver broke through $50. It traded there when the Hunt brothers were cornering the market. It traded there again in 2011. And it got up to this, $50 level, this, psychological level. Hey, it can't get through there. And then it went through. Now it ended up retracing on Friday. But, that's a market that I think can trade over $100 within the next 6 months, and potentially as much as $200 if gold continues going up the not necessarily the way it is, but if it continues its bull run. So, but that there's very few trading models that are going to say that, other than kind of trend following models. But those, I'm guessing that's not quite what you're thinking about. You're thinking, okay, hey, the black box AI models taking in all the various data points. Yeah, I mean, it's hard because also, like, the markets change, and the market structure in natural gas kind of seems like it changes every 3 to 5 years. And so if you've got pricing data from, 8 years ago, that is going to generate a bad signal today. You'd rather not have that data because it's in an entirely different supply demand regime. And but when you take a step back and say, okay, hey, I've been a gas trader for the better part of 20 years, and so I've seen when it's high, I've seen when it's low, I've seen it do crazy things, and a lot of the models just don't sort of include all of that context.
No, very interesting. And the thing you mentioned there about the regimes changing, I forgot your exact wording. I mean, I had someone on my podcast a couple weeks ago who has a commodities trading. He has an energy trading firm, a power trading firm based out of Canada. And he was saying that the number one source of edge within this space is detecting paradigm shifts before they happen. And I think that is very difficult to detect in a purely systematic way.
I agree. But a lot of it comes down to like having, like, once you've seen the paradigm shift once, you're kind of like, oh, I'm going to look out for that again. Now it ends up shifting in a different way, and you get, a lifetime of watching these paradigm shifts. And actually, this is one of the things about being at Goldman Sachs. in the commodities group when I was there was that, there's, 25 or whatever commodities that were being traded. And so there was always something going on in one market, and there was always a paradigm shift happening somewhere in the commodity space. And so, you could say, oh, well, remember what happened to coffee like 5 years ago? Oh, I think that's happening in orange juice, or I think it's happening in natural gas, or I think it's, doing, something crazy. And, the paradigm shift isn't in the natural gas historical data, but it's in the commodities trading historical data. And so, but spotting that, the way that the biggest money has always been made in commodities is by going against the flow. It's just a question of, hey, timing. Can you get, can you fade the market and be right and still be in the position when you are right? So, because when you take a step back and you think about like, hey, what is a trader? We used to say trading is 4 things. So one is idea generation. That's doing your research. Hey, I'm bullish silver right now. Like the balances look tight. And there's a lot of momentum to the upside. And I think it can do something that's outside of the historical price data. Okay, that's my research. All right. So I'm bullish. What do I do? How do I express that view? Do I buy SLV? Do I buy silver futures? Do I buy calls on silver futures? Do I buy the junior miners? Like, what do I do? And actually, it turns out I kind of have a little of most of that. But the core position was long futures. And so, all right, great. Like, I want to buy futures. Okay, how did I do it? All right, well, I started buying when it was in the kind of like low 30s. And it was chopping around for a while. And I bought a few breakouts that ended up not paying out and had to stop out. But my position wasn't so big that basically I was done trading. And so, but the market started moving up. There's definitely a lot of confirmation bias going on. Like when the market is going your way, you think you're smart, so that you should do more. Sometimes you should, sometimes you shouldn't, which gets into, that's actually the 4th point. But the 3rd point is, idea generation, expression. How do you express your view? Execution. How do you get in? Do you just work a bid? Do you lift the offer? Do you buy a little bit every day for the next month? How are you going to decide to get into the position? And then the 4th is money management. And so what do you do when the market is not going well? Oh, I'm willing to risk $1 million on this position or whatever it is. And okay, hey, I got to that point. All right, I need to cut. I can always buy him back, but I'm going to get out today. I'm going to stay disciplined. What I always struggled with, and actually I think a lot of traders struggle with, is what do you do when it's going well? And so, if you bought Bitcoin at $300 and later is trading 750, you're like, man, I'm a genius. But 8 months later, it traded 20,000. So, yeah, it's impossible to know that ahead of time. But like, I think the way that you really have to be honest with yourself. Like, each day at each price, hey, what do I think about the market here? Like, is this trade still one that I want to have on, even though it has run quite some distance? And so, I found that in my historical trading, my worst days were always immediately preceded by my best days. And so, it'd be like make 1 unit, make 2 the next day, 4 the next day, 8 the next day, and then lose 10 the day after. And when I looked at it, over that, 4 or 5 day period, it's like, oh, wow, hey, like, you made a decent amount of money. Now you gave back a huge amount of it in 1 day or in a very short period of time. I think a lot of investors and bosses don't like that P&L volatility. But with my own money, I'm the boss.
Yeah. So you spoke a little bit about the trades you're putting on now. Got a big position in silver. I want to hear about what you're doing right now. So you left DRW and now you've started Green Tiger Markets and you're also trading your own personal portfolio. I guess with regards to Green Tiger Markets, tell me a little bit about that.
Yeah, so Green Tiger Markets, we started it. My business partner Carlos and I flew over to Manila in early 2020, February of 2020. It was his thesis that there needed to be some sort of market for electricity hedging. And he called me up and said, "Hey, what do you know about Philippines electricity?" And I said, I don't know anything. But give me a couple days and let me do some research and I'll see what I can figure out. And in a couple hours time, I figured out, oh, wow, hey, there is a spot market, but there's no liquid, transparent forward market to facilitate the hedging for either generators or consumers. And so I was like, oh, that's a huge gap in the market. And guess what? That's the same way that Intercontinental Exchange started. So we started GTA. So we flew over in 2020. We met with a handful of generators and call it professional people, and think like lawyers and accountants and stuff like that. And then also with some of the utilities and some of the consumers to sort of understand a little bit more about their business, what they were doing, on the idea that, hey, there needs to be a forward market. So that was February 2020. I remember we went into one of the buildings and they were taking temperatures and I was like, what are they doing that for? And so, but it was good for my personal trading. It was really quite good because I figured out, oh, wow, this pandemic, it's not just in China and it's really spreading. And I got short. When I got home, I got short a lot of stuff.
Yeah.
But so Green Tiger Markets, we are a platform for hedging that's similar to Intercontinental Exchange for gas and power, but we do it for underserved markets. And so the first market that we've gotten off the ground is Philippines electricity. And so we've created kind of a family of contracts. So we've got a base load contract. We've got a morning, which is midnight to 8 a.m., midday, 8 a.m. to 4 p.m., and then evening, 4 p.m. to midnight. And the supply demand fundamentals for all of those are very different. And, the Philippines has a huge push towards renewables. That generally means a lot of solar is coming. And so that's one of the reasons why we created this midday product. And we're having some success with it. Now, for the generators, they're a little disappointed that the price has been going down quite a lot. But we've seen that in kind of every, advanced electricity market where you see those midday prices where the demand is highest actually collapse because you have all this added generation coming from solar. And then when the wind is really blowing, that can put some real downward pressure on prices. But yeah, so GTM platform for trading, we've standardized contracts. And so we are matching buyers and sellers, and then we're also the calculation agent. So at the end of the month, we say, okay, party A owes party B, which is a key aspect. There's no clearing available in Philippines electricity, which makes it a challenge to attract market participants. And so it's all bilateral trading with counterparty credit exposure. But, in reality, that's basically the way every other major commodities market started, with bilateral trading to kind of discover price, start to build a liquidity and say, oh, you know what, there really is a market here. There's a need for hedging because the thing is volatile and there's market participants that are looking to hedge out their risk and participate. And it's like, oh, let's bring clearing in, because clearing, everybody thinks, oh, no credit exposure, but it's expensive. Like you have to pay for it. Like somebody takes the credit exposure and they charge you for it. So, but there's some really exciting things. And then, we've managed to sign up about 2/3 of the generating capacity in the country, which we think is a huge win. We've taken on the order of about 18 to 20 million megawatt hours of orders so far. And that works out to USD equivalent, a little under 2 billion notional in just straight hedging orders that we've taken from the clients. The turnover and liquidity still leaves a bit to be desired, but even when I look at, the U.S. gas market today, the volume is 10x what it was, 20 years ago when I first started trading. There's still not enough liquidity. So, it's, the clients always ask, like there needs to be more liquidity. And I say, well, place more bids and offers and there will be. But yeah, it's been a lot of fun, a lot of challenges. And it's an entirely different problem to solve than, figuring out whether, natural gas is going up or down. But, I've got a really great team, that are, really fantastic at what they do. It's a small team, but everybody is like their kind of core area of focus. They're really good. And then they're also good at kind of branching out a little bit. So it makes it, a lot easier for me. Like I don't have to do everything. And because frankly, there's a lot of things that I'm not good at. And so it's really nice having a great team around you.
And I remember when we were on the pre-call, well, actually, Nishant from Verser introduced us, and I had the pre-call with you, and I was really interested in green tiger markets because I'm from the Philippines, and I'd never, to be honest, when I think of the Filipino financial ecosystem, and I contrast it to other parts, it's much smaller, as in the volumes of our of the Philippine stock market are, I think, just in between $100 billion to $200 million, maybe max 300, but it's not that much. And so, one of the things that we were speaking about on call was the liquidity, and you touched on that earlier. Do you think the Philippine hedging markets, for green tiger, do you think that they will follow? Like, do you think they will grow dramatically over the next 5 to 10 years?
I do. So one is the underlying market, the physical market is growing on the order of, call it 5% a year. And so the installed base right now is about 30 gigawatts. And so, Rule 72 says, okay, hey, in, kind of 12 to 15 years, it's going to be twice as big. And so that new generation that needs to be built to meet the demand of the market, along with retirements of some existing facilities, is going to need to get financed. And there's not many banks that will just finance merchant generation. So those companies need to lock in and they need to hedge. And so I think the hedging market really has a tremendous amount of upside potential. And because, there is no price signal. Nobody in the world knows what the price of Philippines electricity is because it's not publicly traded. Well, at least until 2 years ago. But what I can tell you is, USD equivalent for next year base load is roughly $70. And so you might say, wow, like compare that to ERCOT or compare that to PJM for 2026 base load. And you're like, wow, that's pretty juicy. Hey, maybe I should invest in generation in the Philippines because, hey, the prices are a lot higher. And so, but how are you going to make that decision? How are you going to know that that's your investment decision unless you can actually, one, see a price, and two, that price is one that you can actually act on? And so the sort of economic benefit that we believe that we're bringing to the Philippines is you haven't seen it yet, and there's been a lot of naysayers, but it's coming, and we think that the Philippines market is going to be really big and really interesting. And when you compare it to some other electricity markets, like the Singapore electricity market, which is smaller than the Philippines, but actually more advanced, that you can trade futures on Singapore electricity, but they basically burn one fuel there, which is natural gas. And so the price of electricity is basically just whatever the price of natural gas is. And in the Philippines, they have coal, hydro, coal, geothermal. They have the second largest installed capacity of geothermal in the world. They have wind, solar, natural gas, fuel oil and diesel. And so the price moves up and down based on the supply demand fundamentals. If they need one more megawatt and you're running all your gas plants and you got to turn on some diesel, like the price is going to go up a lot. And so that price volatility is what is the signal that the market sends that, hey, like you need more hedging to be happening. So, consumers can't be exposed to those price spikes, and the generators are saying, well, hey, I need to know that, hey, I'm going to get, a certain price for my commodities so that I can make this investment. So, it's with a lot of good things happening.
For sure. Like, I think in terms of economic benefit, it's tremendous being able to lock in a price for a year from now or 6 months or whatever that may be. I guess my question now is more about how important the sophistication of the market participants is for something like Green Tiger. And what I mean by that is, comparing an emerging market like the Philippines to the US or to Singapore, in general, just the market participants are just not as sophisticated. And does that, like, how easy is it to trade with Green Tiger? As in, would anyone just be able to go on the platform and hedge out? Like, what does the process look like?
Yeah, so maybe addressing the last question first, like who are our clients? So we take confidentiality very seriously, but they're all large commercial market participants. So either generators, retail electricity suppliers, consumers, utilities that are already active in the physical electricity market. Now, Green Tiger is actually a Singapore-based company, and we fall under the purview of Monetary Authority of Singapore as they are the regulator. And we operate in an unregulated manner because we meet two characteristics. So one is we only offer commodities or derivatives where the underlier is a commodity. And two is all of our clients are, quote unquote, accredited investors. And for corporates, it's roughly 10 million. I think it's 10 million Sing dollars of net assets is the minimum balance sheet that they can have. So there's no moms and pops or doctor and dentists on the GTM platform. So far, it's all commercial players, though we're definitely looking to attract, I would call them kind of financial players or market makers. Like as a former trader, I can attest to the fact that the market making in Philippines electricity is a lot more lucrative, or potentially the margins are much wider than it is for U.S. nat gas. So I think we're going to get a market maker here pretty soon. But yeah, it's all commercial players today. And as far as the sophistication goes, when it comes to expertise in derivatives, the client base is definitely less experienced in the Philippines. But this is not, we're bringing a new practice to the Philippines. Now, we're very experienced with it. I've worked on Wall Street for a long time. And actually, I traded my stock when I was a teenager. So, I've been around financial markets for quite some time. And so we find a lot of our time is spent teaching. And so it's one of the things that I found that, hey, I really actually enjoy doing. And I love going in to meet various clients. Hey, it's kind of like, hey, tell me your problems. I'm sure I've heard much worse. And so they'll say, oh, we've got this plant, this project, these other things. And I'm like, oh, okay, well, hey, you should consider selling this at this price, this at this price. Hey, you've got 100 to go. I would suggest offering out 20 or 25 today. Hey, I think I've got somebody that can, get matched with that, and sort of solving those risk management needs of the various clients is a lot of fun for me. The challenge is, I'm sure you're familiar with, kind of the Philippines business structure, but it's generally kind of a top-down culture where the top guy is telling the people below what to do, and there's not much information that's going up, or there's less information that goes upwards, and that creates some challenges. It does have some advantages though, because if you get in and you're meeting with a top person, they just tell their people, okay, hey, we're doing this, and go execute this thing. And so, but it's not easy always to get into the top guys at the various firms. So,
And what you mentioned there about the top-down hierarchical structure, I can fully attest. And it's funny because whenever I go back, even just eating at a restaurant, they'll always call you sir, right? Compared to, I mean, for me that's normal because having grown up there. But I think it's good to hear that. I find it interesting. Like your a lot of your time is spent on education and teaching your clients how to use your products well, and I find it interesting. So I guess, so I don't have that much context on this. For ICE, like anyone can trade there, right?
not ICE. Well, one, you need to have an account with a clearing member because it is futures getting trading on ICE. So, and not every clearing broker is set up on ICE. Now, a lot of them are on CME. But basically, like anybody with about $20,000 can trade on CME. The margin on one silver contract is now like $35,000 or $40,000. So you're not trading any silver, but you can definitely trade some natural gas. And but yeah, as an individual speculator, the barriers are fairly low for that. Now, trading futures has risk, and that can go against you very, very quickly. But it's I think it's great that individuals can access the same markets that basically the professionals can.
I want to hear a bit more about doing business in the Philippines from an American's perspective. And I'm very interested in this, having grown up in the Philippines and living in the U.S. now. What's that like? What was the dynamic like going there in 2020? Flying there regularly.
Well, so I didn't start flying there regularly until 2023. So I flew over in February of 2020, but it's basically closed to foreigners until like Thanksgiving 22. And then I think that definitely when I was there back in September, like the Christmas music was already playing in the malls. And so, Christmas season is kind of like, September through early January. And, the pace of business tends to slow down. There's a lot of holidays. I mean, that was one thing, one big difference. The Philippines has 19 holidays and the U.S. has like 7. So, and then you had things like Columbus Day where the bond market is closed, but everything else is still open. And so, yeah, it was, like going over there, for the first time. You're walking around as pre-pandemic, you're like, wow, like it has these emerging market vibes. There's growth, man. There's so much opportunity here to do something. Wow. Every time I've been to Asia, I've always kind of felt like that. And so, but obviously the pandemic had some pretty large impacts on the Philippines in particular. And there's a lot of aspects of it that it hasn't fully come back still. At least some parts of the business. So, but yeah, in terms of, let's see, your question was, what's it like, sort of doing business there, and it's I don't know, it's just different. The pace is much different. I think, like in the Philippines, there's a lot of nonverbal communication. And so you can kind of have a whole conversation without talking to somebody. And also because I do come from a background of, working on Wall Street, that there's a little bit of nervousness on some clients, not all of them, but some clients' perspective to raise issues or to ask questions. And culturally, like I think about it is like in the U.S. It's celebrated to be first. I think like the first man on the moon, the first person to break a 4-minute mile. I think that was an Englishman, but the idea of being first is celebrated. And it's not just the Philippines, but it's kind of Asia in general that people don't necessarily like to be first, or they really don't want to be first, but they really want to be second. And they're like, this is a good idea. I want to do this, but I don't want to be the guinea pig. And there's a that's valid. I get it. But for our business, we have to overcome that. And the way that we overcome it is by staying professional, and providing excellent, or like a platform that works really well, products that do exactly what we say that they're going to do, and then we help the clients to basically implement the various strategies. And it's a constant education process along the way. So it's a different challenge than I experienced, at Goldman. Now, I was on the trading side, but when we would go and have client meetings, I found the clients had more to offer than I did, despite sitting at kind of the information center of the universe. The clients always had like nuanced piece of kind of localized information that you just, you gotta be in Oklahoma City to hear it. So, and I don't know anybody who can yell that loud from Oklahoma City to, the trading desk of, Lower Manhattan. So, yeah, it's different. It's a new challenge. But I really, really enjoy it. And so, I'm over there kind of 5 or 6 times a year, and I typically go for 10 days to 2 weeks. And it's about all I can handle. The tropical heat, and the traffic is just, oh yeah. It's so I just like I gotta go home. I gotta be in a quiet place for a little while. But yeah, it's been a lot of fun, and I'm looking forward to the liquidity building, and where the clients that we met in 2020 and 2021 over Zoom, a lot of them have now joined. They're starting to do their first trades. And, when we get a year or two down the road, we can look back and say, hey, remember like that trade that you put on? Like, hey, I know it ended up losing money, but remember at the same time, you had this offsetting piece of risk that you're hedging. And look how much bigger your business can be now, because you have another tool at your disposal for managing risk.
And you started this with your business partner. I think his name was Carlos, did you say?
That's right.
Yeah.
Carlos. Yeah.
And how did that idea come about? Like, he just called you up and said, do you know anything about the Philippine electricity markets? Because that's very, very niche,
Yeah, so Carlos is a brilliant guy. And he is a technologist at heart. So he grew up at American Express and basically rebuilt their payments platform. And so that's a huge build from a technology perspective. Like, it needs to be 100% uptime. It needs to be fast. It needs to be able to process a lot of transactions. And it needs to be easy to use. So those are really big challenges. So he comes from a technology background. And so he decided to basically kind of leave American Express and technology consulting in the U.S. and moved to Manila in 2015 and started a firm called Pasig and Hudson. And so Pasig River in Metro Manila and the Hudson River in New York. So kind of a foot in both countries. And actually, he spends about half his time there and half his time in the U.S. So he's done technology consulting in the Philippines to basically bring some of that expertise, particularly to the banking system. He has several large clients at the various banks, and but he met somebody who I think was either a consultant or somebody that asked Carlos, "Hey, hey, there should be this like hedging market for electricity in the Philippines. Do you know anything about like trading or commodities? And he said, no, but I know a guy, and that guy was me. So yeah, he called me up, and I had just met him briefly on the previous project that we were both working on, and but I really liked him, and he's a super smart guy, unbelievably nice, kind gentleman, and yeah, the rest, as they say, is history. So
That's fascinating. Because when I zoom out, John, and I'm talking to you right now, it's pretty like from Goldman Nat Gas to building a new exchange in the Philippines. That's just it's pretty wild. What's been the biggest surprise along the way?
biggest surprise, aside from Bola, um, yeah, I still haven't dipped my toe into, but the um kind of the genuine passion that so many Filipinos, both some of our employees and at some of the clients, the passion that they have for really doing excellent work. It's really easy to just say, oh, you know what, hey, it's a really poor country because people are lazy, and that's not actually the case. It's a poor country for a lot of reasons, but it has so much potential, and the resource base there is amazing. The human capital there is really fantastic. And bringing something as simple as a transparent market in electricity. I mean, if there's one thing that we know, it's that demand for electricity and economic either growth or output are like one-to-one correlated. And so the more energy that countries are using, basically, the better off that they end up becoming. And the Philippines, the installed capacity, is, like I said, it's about 30 gigawatts for about 120 million people. It's so Texas is like twice or three times that, with a third of the people or a quarter of the people. So, a vastly different, energy usage dynamic. But if we can bring this forward market, and if you think about the U.S. nat gas market, when I was an intern in 2002, they were talking about how we kind of run out of places to drill for natural gas, and that, hey, this thing can go anywhere. And the cure for high prices is high prices. And so the combination of Hurricane Rita and Katrina, and then the massive Tokyo, or not Tokyo, I think it was a Kobe earthquake that knocked like a huge amount of Japanese nukes off the market. And then they started importing a lot more LNG, and the US was a big importer of LNG. And so it was a beauty contest basically between Japan and the US to see who could take the price highest to attract cargoes or kill off demand. And so the price trade $16 in US nat gas. And I still remember it was 4th of July weekend, 2008, and Chesapeake Energy came out and said, hey, we found the Saudi Arabia of gas, and it's in Louisiana. And that was the Haynesville Shale. That really kicked off the shale revolution, and you basically saw prices go from 16 down to $1.50 at some points in time. It's like $3 right now, but it's still compared to energy anywhere else in the world, it's the cheapest. And it's like, why is it the cheapest? Is it the geography? Is it the geology? Is it the fact that we have a great legal system, or a trusted legal system, deep financial markets, or is it something else? And I think you probably know that what's coming is something else, and that is the existence of the Henry Hub futures contract, and the fact that as a producer of natural gas, you can sell 3 to 5 years out in effectively unlimited volume, and lock in a price today then go and contract out drilling rigs and pipe and all that stuff and lease out land and then get that stuff out of the ground and then deliver gas, not necessarily into those contracts, but into, a roughly similar location. And it's really powerful, that price signal that gets sent to the market. Chesapeake Energy was a huge client of Goldman Sachs, and they were tremendous users of the forward. Now they traded forwards with Goldman, and then we would go and trade futures. But it's basically the same thing.
When you say it like that, being able to lock in a price and sell electricity 3 years out, like when you actually put that into context, like financialization of products like that, it's just, it's crazy. Like it's like when you actually think about it, it's like, whoa.
Well, so think about it like this. So in the Philippines, for me to want to build a new power plant, I've got to have a very, very high level of confidence that the prices are going to be high and sustained high for a long period of time. And because, I'm going to ideally try and sell to one of the utilities like Meralco or somebody like that over a long-term contract. But if I'm just building the plant on spec, I need to have confidence that the price is going to be high. And so if the only thing that you can see are historical spot market prices, that doesn't really tell you a whole lot about what's going to happen tomorrow. It tells you a little bit, but not as much as, wow, there's a liquid forward market. And, oh, wow, you know what? Hey, I can lock in the price of my Indonesian coal, and I know what the transport cost is to get it from there to Luzon. And then I can sell my forward electricity price. And then, hey, that whole transaction, hey, my IRR is 20% or something like that. And I can lock that in today. All right, let's build that. And let's keep locking it in until I don't earn the 20% returns anymore. But today, I don't know what IRRs the developers are going for, but my guess is probably more like 30 to 40. And so, because it's risky, because, hey, if they're wrong, hey, then they're going to earn 10%. Whereas hey, if you're doing a 20% project and you're wrong and you lose 10%, you're like, wow, that's a problem. But if you can lock all that stuff in and basically turn that business into a bond, then it's really financeable. I think the goal, I think, for the Philippines is to get electricity prices lower. They have some of the highest electricity prices in the world that are paid by some of the poorest people. And, I think that's wrong. But lower realized prices do not necessarily mean that generators make less money. And in fact, they could actually make more money, similar to when the margins compressed at Goldman, we made more money because we were able to do more of it. And so the, prices coming down, that's going to put some pressure, some immediate pressure on balance sheets, but it's already happening, and it's not because of us. It's because supply demand fundamentals are changing and the price is going down. You can see it in all the earnings reports. They're, basically every generator is down 25 to 50% year on year in terms of their earnings because spot market's been a lot lower. But had they all hedged, and each one of them could have sold their entire volume that they took to the spot market on GTN. And, we looked at all the bids that have been placed in the last 12 months. And we said, hey, if you just hit every single bid, you could have sold, I think it was 7 million megawatt hours. And the P&L on those trades was on the order of 100 million US. And so do the math and you're like, oh, wow. It's like the average margin. And this is hitting every bid, even the bids that were crazy. If you hit every bid, you would have, on your hedge, made $100 million. And, that works out to, what is it? 6 billion.
6 billion pesos. Yeah.
6 billion pesos. And you see kind of the holes in the balance sheets, or the holes in the earnings reports of, the 10 biggest generators. And it's all between 2 and 5 billion pesos, underperformance year on year. And you're like, oh, okay, well, hey, had they hedged and built up the market, they could do more projects. They would say, hey, I've got an extra $100 million that I can invest in new projects. And so, hindsight is 2020. Like there's a lot of factors, like the price of coal came off 35% year on year. There's a lot more solar that came to the market. It was El Nino last year versus like a much more balanced and actually a pretty wet year this year. So there were a lot of things that were leaning bearish, but like I think that says, wow, like you need to hedge because you don't know, like maybe it's wet again next year. Maybe there's even more solar that comes to the market. Maybe there's, a recession. And hey, if I'm wrong, well, at least I know today exactly how much money I'm going to make next year. So, and that's, for a business person, that's hugely valuable. You look at the earnings volatility of companies, those that have volatile earnings, their stock price and their valuations are pretty low on a relative basis. But if you're like consistently, hey, I make $1 a quarter, and then that grows at 2 to 5% a quarter, like your stock is going to trade a lot higher. Yeah.
No, John, I think you're doing great work in the Philippines. I think it's, yeah. And like, thanks so much for coming on the podcast. Really enjoyed hearing what you had to say. You have a pretty crazy story, and all the best, man.
Yeah, thanks so much. When next time you're in Metro Manila, let me know, and we can meet up. So, but yeah, thank you so much for having me. It's really been a pleasure, and look forward to chatting again in the future.
Thanks, John. All right.